Again, a very important emphasis on revenue recognition, one of the principles we talked about. So it should be recognized that revenue in the period it has been earned. Business and transaction should only be recorded when the sale has been made or earned. It doesn't say when the money has been received. It is only at the time when you invoice. So in this case down here, you have a situation at the point of sale, which you see here. You at the rate point of sale is the time when you will record your transaction as an income. Not say, for instance, if you are manufacturing things or making products, it is not that time when you make the product, you earn the money. It doesn't mean that. Or nor is it at the time when you receive the cash. It is always at the time when the point of sale. At the point of sale, you will actually be recording it as an income. Points to note, when client is invoiced, revenue is recognized not when cash received, but when invoiced. That's something which you got to always remember, all right? It'll be recorded at the time when you invoice your client. Similarly, service tax is triggered when the billing is done. Not is when you collect the money from your client. By the time you invoice your client, if you are subject to service tax is triggered. Collecting deposit is not revenue recognition. Collecting deposit is a pure form of your client paying you in advance because you want to have assurances that you want to work on this case or whatever. Okay, a couple of small bits of things to look at. Some just simple questions. Rainbow Corporation reports revenue, it's an income statement when it is earned instead of when the cash is collected. What principle is it? What is the principle of not recognizing it when it's earned but not when it is cash is received?
Oh, Mr. Nakulan, Wei Tan actually said revenue recognition principle.
All right, excellent. Yeah, okay. Revenue recognition. A business may only report activities on the financial statements that are specifically related to the company's operations, not those activities that affect the owner personally is known as what? You got to separate the business and the owner.
Separate business entity?
Correct. Separate entity concept, right? Keeping them separate. This is very important, huh? Because when it comes to tax, this is very important. Your tax guys will haunt you if you've been charging things which are not related to the business, but you're having parties in your house and stuff like that. You're putting it into your business. Okay, so those are very important things.
What if I'm a sole proprietor and I'm having a party as part of my networking to get...
Yeah, but you know what happens when you have a party, you can call it entertainment expenses, but the revenue department always have certain restrictions on entertainment expenses. Nowadays, the entertainment expenses in terms of tax revenue department is only for your employees. So they have taken out the fact of entertaining clients and this and that and all, because it can turn into a bit of an awkward situation, especially heavy entertainment on clients, right? But even that, sometimes they come back to you and say, there's quite a bit of restriction. They put it at their own discretion. You claim for your petrol and toll in your business, all right? Going from your house to your work and all those things and traveling around, you claim for all those things. The revenue department comes back and says, there is an element of personal use in this. So if you had claimed 10,000 ringgit for your petrol and toll, they might come and tell you that one third of it could be deemed to be personal and 2/3 is for the business. All right, they take this kind of discretion decisions on this kind of things, so you got to be careful when assuming a business will continue to operate in the foreseeable future. What concept is it? We are not going to liquidate ourselves. We are going to be there in the foreseeable future operating, guys.
Going concern. Rajeshri says going concern.
Oh, that's right, going concern.
Done.
Right. So this is all important, some of the key concepts of accounting. Nikon Company reports land on its balance sheet at the amount it paid to acquire, even though the estimated fair market value is greater. So if you record it at the time, what you paid for it, what concept are we using? What is the transaction? What is the actual transaction we took place?
Matching principle.
What is the actual amount you paid for is known as what?
Oh, Celestina says cost principle.
Yeah, cost principle. Okay, just a little bit of recap of what we've done. Okay. I'm sure you would have, a lot of people would have heard somewhere in their lifetime about debits and credits, but we are not going to be talking about debits and credits. We will take a more logical approach of looking at what this whole transactional equation, accounting equation is all about, all right? So at the end of the day, the accounting equation is to drive something to balance. All right. At the end of the day, it is to balance something. Key accounting equation you need to understand is assets. You have assets in the business equals to liabilities plus equity. Equity in this term is owner's capital, your capital which you put into your business, and plus the liabilities gives you asset. This is the fundamental equation of accounting. All right. This is how the whole thing is derived at the end of the day, using this concept of assets. There are three key elements in the business: asset, liabilities, and capital. That's the one which structures the whole business. These are all your assets you could have in your business. Cash is an asset. Accounts receivable is the monies you have billed your client or your customer or your client owes you. It is known as receivable. You have office supplies, you have store supplies. If you buy equipment, computers for your business, or if you have a building which is used in your business, your own building or land, or you have prepaid certain things, prepaid expenses in advance you are paid. All these are assets, right? Liabilities, all right, these are things you hate to have. Accounts payable, all right, you buy a lot of stuff, all right, you buy printer ink, you buy stationery, you buy this, you get some billings from some of your suppliers or what, and you owe your suppliers. That is technically, it's called accounts payable. How much is payable to your trade creditors? And then you have many other kind of liabilities. You have tax liabilities to the revenue department, all right? You could be having salaries payable to your staff or bonus payable to your staff, various things of some amount of money payable to courts or whatever. And then you have short-term or long-term loans. Typically, short-term liabilities are if you are funding your business through some means of overdraft. You got bank facilities in terms of bank overdraft. Bank overdraft are deemed to be short-term liabilities because they are revolving. Long-term liabilities are things you would have taken for a longer period. It is things like you would have taken a mortgage or whatever to fund your building or whatever, or any of your assets you have bought. So these are typically liabilities. So you have liabilities, you have assets. Then equity. Equity means capital. All right. It is a more of a corporate term, which is called equity. But in your term, your language, for your firm, whatever partnership you have in, you will be putting some money into your partnership to start the business. That's known as equity. And you see two arrows here. If you bring money into your business, owner's capital, it will increase your equity. If you bring income into your business by the way of revenue, it will increase your equity. In respect of owner's withdrawal, as partnership accounts you have your business, you draw money out of your business, it will reduce your equity. And the same way, your expenses in your business will reduce your equity. So equity will get reduced by expenses and withdrawal of money from the business, and equity will go up when you put in more money into your business and revenue comes into your business. Again, coming back to the equation, assets equals to liability plus equity. So you have owner's capital. If you put more money into your business, owner's capital will go up. If you take out money from your business, owner's capital will come down. All right. You see the arrow going down. This is what happens to equity. If you have revenues coming into your business, equity will go up. If you have expenses, equity will go down. So what is the net of revenue minus expense? You either get a profit or a loss. So if you have a profit, equity will go up. If you have a loss, your equity will come down, which is your capital. So your equity is being impacted by all these scenarios down here. So what we'll do next is we will look at every aspect of transaction, very simplified manner of looking at it, in a kind of the impact, what it has to assets, liabilities, and equity. Assume you invest or you start a business, your law firm, you put 30,000 in cash to start your business. So when cash comes in, what is cash?
Asset.
All right. What happens to your asset?
Goes out.
What are you starting the asset? What is the cash for?
Capital.
Yeah, equity. Equity goes up. This is accounting 101, no debits and credit, but really debits and credit are playing here. All right. In reality,
Well, Nakulan, you're stressing Sheila out. She's the only one responding.
You guys.
I think she's enjoying herself. Okay, anybody can answer these questions. In your business, you purchase furniture paying 10,000 ringgit in cash. So what happens in this case? Some other volunteers?
Asset.
What is furniture?
It's an asset.
So what happens to asset? Asset goes up?
Yes.
Cash, you pay cash, cash goes down. So here, two things happens in assets. Cash is converted into furniture. That's what is really happening. Cash goes down because you're paying cash. Asset goes up because you're buying a furniture. It comes as a furniture, is an asset. You perform consulting services or you charge your client out for some services and you receive 2,000 ringgit, $2,200 in cash. So what is, when you charge consulting services, is it a fee?
Yes.
Is it an income? So
Yes.
what does income does to your items here?
Equity goes up.
Equity goes up, and when you get it in the way of cash, your cash goes up. So you see, for every action, there is another action or reaction in any of these items, whether it's assets, liability, and equity. All right, two entries takes place. All right, yeah. You paid for rent for January 1,000 ringgit and salaries to the business employee 700 ringgit in cash. So what happens when you do this? Does your cash go down?
Yes.
Yes.
Liabilities, equity down.
Cash goes down. All these are expenses. Equity goes down because it's an expense. Revenue drives equity up. Expense reduces equity.
Is the liability affected?
If it has been charged earlier and invoiced out, so what we are saying is, if it has been recorded as an expense earlier and then now you're being paid for, that's different. But I'm just taking it as the time when you're paying it, it's all being recorded at the same time. But technically, normally, even though it is being paid later, you will be actually recognizing all expenses when it takes place. You paid $900 to settle accounts payable. So you paid $900. You paid cash $900. So what happens to your asset?
Asset goes down. Equity
And
goes down.
No.
Liability goes down.
Accounts payable is a creditor. You have already recorded the creditors as an expense before this, and that's why it transformed itself into a creditor. It's a liability. By paying the liability, your liability goes down. You purchase a motor car for 100,000 on hire purchase. So what comes into your company?
Asset goes up.
Liability
Equity goes up as well.
Okay?
Equity, doesn't equity go up?
No, only equity won't go up because you have brought it as an asset to the company and you are buying the asset not by cash. You're buying it and on a HP is your liability. Your equity will get impacted afterwards. What happens to your equity is later it'll get impacted whenever you charge by the way of depreciation into your profit and loss account, which you will see later. You withdrew cash as a partner in your company or your business. You withdrew 15,000 in cash from your business as a drawings. What happens?
Asset goes down.
Yeah,
And equity goes down.
exactly. That's what happens. Because drawings, you are reducing your capital of your firm. Good to go, guys? What time is your bedtime normally? 9?
No, we're getting it. We're getting it.
Okay, very good.